Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Northstar Clean Technologies. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Aidan Mills, Chief Executive Officer of Northstar Clean Technologies, which trades on the OTCQB venture market under the symbol ROOOF and on the TSXV under the symbol ROOF. Welcome, Aidan.
Thanks, Bob. So, as Bob said, thank you very much for the intro, and thank you very much for the OTC for hosting the conference. It's always great to be in front of this marketplace, given the scale and size of Northstar. As Bob said, we trade on both the TSXV and the OTCB. So Northstar we are a clean technology company. We have developed a proprietary technology for taking asphalt shingle tiles that are often destined for landfill and splitting them up into their individual component parts. So a shingle tile is about 50% aggregate, about 25% kind of fiber fiberglass, kind of the filler that goes into a tile, and about 25% asphalt. And so our proprietary technologies, takes a tile on the front end of our process, and out the back end of our process comes those three individual components: the aggregate, the fiberglass or fiber mix, and the asphalt. And so the question really, often people say to me, I've been in this role, my history, kind of 19 years at BP, about 5 years at Husky up in Canada, a couple of years at Goldman, and then back into the oil industry. And so one of the things when I joined Northstar that people often ask me was, well, why did you go from kind of, these multi-billion-dollar companies down to kind of a startup? So at this point in time, as we think about energy transition, to me, energy transition is really important, and it's not an energy transition whereby we're all going to be walking to work and driving EVs tomorrow. It's all about transition, and it's all about transitioning away from things that can really be improved. And one of the things that's really important about energy transition is scale. So can we actually, impact something that's happening significantly with scale? And that's the reason that I joined Northstar. So these are 2022 figures. So in 2022, more than 16.5 million tons of shingles went into landfill. So as an ex-oil and gas guy, that's an incredible figure to me, because it's over 20 million barrels of oil at an annual equivalent, using that kind of roughly 25% asphalt that's on a tile. And so because we have essentially the proprietary technology, and we will likely have the first commercially available technology to solve this problem, that was the reason that I came to Northstar, and that's what our business is going to address, which is to tackle this 16.5 million tons. So just to give you a bit of a perspective about a Northstar facility, each one of our facilities processes 40,000 tons. So when we go to a municipality, we can say to a municipality or city, you can divert 40,000 tons of shingles away from your landfills to our facility. But that just shows you, if we were the only technology solving the 16.5 million problem, we'd have to build 400 Northstar facilities. So the industry has also realized that this is an important issue too. So the Asphalt Roofing Manufacturers Association, which includes all the big asphalt roofing guys, so that's the Tamcos, the ICOs, the Owens Corning, GAF, etc. They're all part of ARMA. And Arma came out with a strategy statement that said that they would like to reduce the amount of the amount of shingles going to landfill by 50% by 2035 and by 100% by 2050. So this is kind of like the asphalt roofing manufacturers. This is a bit like the oil industry, carbon zero statements, where the oil industry have said, by 2050 they want to be carbon neutral. So this is the asphalt guy saying, listen, this is an issue, and so increasing the amount of recycled nature, the amount of aggregate that goes back into the tiles, the amount of recycled oil that goes back into the tiles, is something that they want to do, and obviously diverting away from landfill is a key priority. So if you look at the Northstar technology, so what we basically do is, as I said, on the right hand side, you'll see the asphalt shingles coming in at kind of 100% of the feedstock, and then out the back end comes 25% fiber, 50% aggregate, and 25% asphalt. And if you look at the revenue on the left hand side, there's two elements to the revenue for Northstar. So number one is the tipping fee, and that's if you bring them, no matter what jurisdiction you're in, if you bring a ton of shingles to landfill today, you have to pay a tipping fee. So we collect the same tipping fee, and the strategy that we have is to locate facilities close to landfills. So it's very easy for a roofer or a waste collector to turn left to us, and we're close to the landfill. And we generally discount that municipal tipping fee to attract people to economically switch to us as well. And so if you look at the revenue, and I'll take you guys through the revenue a little bit later on, but if you look through the revenue for the business, 35% roughly, or 36% comes from the tipping fee, and 64% comes from the products. And overwhelmingly, the biggest value in the business is obviously the asphalt that comes out the back end. The fiberglass or the fiber and the aggregate can go to local markets and are kind of like building prices, but obviously the liquid asphalt, and in all our agreements, which are priced based on asphalt oil price, is the highest value that we have in the business. So one of the questions we often get asked is, and so your technology is proprietary, is it protected? So the process is divided essentially into three. So the first step removes the sand, the second step removes the kind of fiber, and the last step is the asphalt separation. That was submitted and got through US Tier 1 fast track patenting. And the first step is patented, and we have issued or applied for step 2 and step 3 as follow-on patents. The patent has been fast tracked as a green technology patent in Canada, and that's undergoing assessment. And we also submitted the patent for international patent protection, which is the PCT process, and that will be coming to conclusion this year as we decide which countries to progress that with. So in the development of the technology, we have a pilot plant in BC, in Vancouver, and we have the first commercial facility is ongoing in Calgary and Alberta, where I am today. So the pilot plant we ran for a year, and that was really important because obviously with any new technology, the most important thing to do is to de-risk it. And we did that kind of at the pilot plant in kind of three ways. So we ran the operation, and so that's, of the 15 processes that are in this technology, it's good to understand, well, how does it transfer from step 3 to step 4, and how does step 9 work, and is step 11 doing what it should do? So we did the whole kind of front to back operation of the facility. We also had key vendors, where we have proprietary pieces of equipment, purchased pieces of equipment from vendors that we're using in our process. So we worked with the vendors in terms of the performance of some of those pieces of kit. And then the last thing was the customers. So when I first joined Northstar, our customer base, the original thought was, let's think about this as a business that can supply, local manufacturers with roofing products and road products. And my view was, as a strategy, that wasn't the strongest strategy, and the strategy really should be to provide these products to multi-billion-dollar companies who were either in the roofing business or in the paving business or actually in the flat roofing business, because those are the guys that are under, number one, the guys that want to divert away from landfill, the ARMA representatives, but also they have, ESG targets for lowering their carbon footprint and also increasing the amount of kind of circular nature or recycled nature of their products. And so one of the things we did as part of the strategy was the engagement with big customers who could do advanced R&D to give us feedback on the technology. And so that has all come together for our first scale-up facility in Calgary. And look, there's lots of ESG companies that talk about, and we're going to deliver this technology in the future. And often it's kind of 2 or 3 or 4 years away. This plant will come on by the end of 2024. So we're literally just coming out of detailed design. All the long lead items have been ordered. Actually, the design is going through HAZOP this week to finally lock it down. And so this is, and obviously everything going out for fabrication for the skids, etc. And so we expect this plant to be commissioned in Q4 this year. And so as an ESG story, but also as a manufacturing story and as a significant waste diversion story, this will be operating by the end of this year. So this isn't a presentation of, bear with me, we're going to have this in 5 years' time. This is a bear with me, and we're going to have this in, the next 6 to 9 months. So here's the project status. So this is our site in Calgary, on the top left-hand corner here. And you can see the concrete plinth already. It was already in for the waste scale. And you can see on the bottom right-hand corner, that is the first revenue generated by the site, as I discussed from the tipping fee earlier. And so that was the first feedstock delivery on January 17th this year, on a very cold and snowy day. And then you can see the shingles being delivered onto the site on the bottom left. So strong progress with respect to the project. And here are the industry partners I was talking about. So ICO, major shingle manufacturer, they have entered into a contract with us for 5 years for the delivery of the feedstock for Calgary into the facility. And then the off-takers for the facility are McAsphalt. So they're the Canadian subsidiary of Colas, the multi-billion-dollar French asphalt conglomerate. And so they're buying the asphalt from the facility for 5 years at a market-based price. And then we have a strategic investor in TAMCO, so the big US shingle manufacturer, invested $10 million US in the business in the middle of last year. And the agreement with them is, so they will be, for the first 3 US facilities, which I'll talk about in a minute, they will be the offtake partner for that. So those and all of those 3 companies have been doing R&D on the products produced by Northstar, and McAsphalt and TAMCO have obviously entered the long-term agreements. So when I'm asked by people, does your technology work? My answer is, look, I could CEO Armwave and use lots of Irish charm to try and persuade you guys that it works. But actually, the R&D teams from McAsphalt and the R&D teams from TAMCO, those are the guys that have been looking. And McAsphalt have obviously done an offtake agreement because they believe it can go into roads, and TAMCO have done an offtake agreement because they think it can go into shingles. So if you think about our 3 market segments, paving, shingle manufacturing, and flat roofing, of the 3, we now have partners in both paving and in shingle manufacturing, which is incredibly strong and shows the commercialization potential of the business. So Calgary is fully funded. So each plant roughly as we kind of roll these out is a kind of about 15 million Canadian of capex, and kind of 3 to 5 of associated costs depending on land lease and ramp up rate and all that kind of good stuff. So the Calgary facility is funded not only by the TAMCO strategic equity. We said the debt is coming from a Canadian bank at BDC, but also one of the strategies for the business is to engage governments for government grants, and so we secured 200K from Alberta Innovates, but more importantly 7.1 million Canadian from Emissions Reduction Alberta. We were part of an industry call for funding, and were awarded 7.1 million, which was 100% of what we asked for actually. But that was a circular economy challenge, and so again, as part of the strategy of the business, engaging with municipalities, engaging with provinces, engaging with states on circular economy funding is something that's part of the strategy. But it's really important to demonstrate that that's not that element of government support is because the government support is there. This business does not need that to work. So if you look at the base case economics for the Calgary facility, ignoring irrespective of the funding, the revenue per facility based on, as we've said, the tipping fee and the products coming out the back end is around 10 million, 9.7 million Canadian, so roughly 10 million per year. And that generates an EBITDA of just over 5 million. So good, strong margin capability. And these economics are actually fairly conservative because they're based on running the facility 10 hours a day and 6 days a week. Because this has a hydrocarbon back end, it can easily run 24/7. And the only constraint and the reason that we've been relatively conservative with the economics is that we don't have, is the feedstock capability. So if we can secure more than 40,000 tons, then the incremental capability on the plant is literally just man hours. There's no need to worry about additional capital to improve the efficiency. The other thing that's super important about this too is the carbon benefit. So one of the reasons that these, the partners that we have been attracted to our facility is the I want to click one slide, is the life cycle assessment and the carbon footprint of the facility. So if you take a ton of shingles and you put it into landfill and you replace that, 25% roughly with virgin production, the carbon CO2 equivalent produced by it is about 195 kilograms, so about 200 kilograms, roughly 20%. When we did the front end engineering design for our facility, ours is 77 kilograms. So it's a 60% reduction versus the base case of the life cycle assessment. Now, to be fair, we obviously have to, now we've finished detailed design, we have to redo the LCA, and we'll have to redo it when the facility starts operating. But this is the high level 60% reduction versus the base case. And also, as you know, there's emerging thinking about the economic value of diverting away from landfills. So the 20,000 tons or 40,000 tons per facility going away from landfill, and that is not included in any of these economics. So that's just upside. Because I was super clear when we went into this business first. There's so many ESG businesses where investors not worry, but investors see that the underpinning is based on the carbon price or some other environmental number. That is not in this case. So this 10 million excludes all carbon credit benefit because this is a smart idea energy transition manufacturing business that has huge ESG upside and a very strong customer base, of course. That's all right. We're going. Okay, so when we IPO'd in 2021, if you look at the column on the left hand side, you can see all of the where we were with respect to the patents, the strategic customers, the technology, and how far we've come. So now we have, as I've discussed, patents in place, strategic customers in place, technology de-risked, the commercial facility fully funded and under development, government support, debt support, so strategic investor, obviously with respect to Tamco, feedstock supply, with ICO, and environmental benefits as we've talked about as we've done the LCA. So as you think about businesses that are progressing, and where we're at from a development perspective, this is not this is not early development. This is manufacturing facility ready to build. So the Calgary facility, as we've said, is next, and then the next two after that will be, from a Canadian perspective, will be likely the Toronto and the GTA area, and more importantly for the US will be the first US facility alongside Tamco. So we are working with the Tamco team to identify which is the first facility, and that's actually one of the catalysts that we should have this year is the announcement of that. As we think about the growth, I mean, this is the classic hockey stick growth for that a CEO always does a bit of arm waving in. But ultimately, we believe we should be able to build 3 facilities per year ourselves. And once this technology is established, that we should be able to license 3 facilities as well. And just to kind of orientate this growth, although this looks like an aggressive growth plan, if you look at that 2030 number, if we had to deliver, if we were the only technology that delivered the industry solution by 2035, we would have to build 200 Northstar facilities. So that shows you the gap between the 31 and the 200 is just an expression of how big this market is, and how we'll need a number of solutions to solve it. Then quick outline on the pro forma. So mainly retail investors. We have insiders management of 15%. Tamco have come in with preferred shares, and they came in for that. They've got a 1-to-1 conversion to common, and we have one US institution that owns about 5%. And then the catalyst for this year, we've got detailed engineering has commenced, and we expect to finish that here in the next month or so. We have the supply with ICO, and then, as I said, the 2 development areas of Toronto and the US, commencing construction at the Calgary facility, and then obviously, as we've said, Q4, commissioning and operations at Calgary. So if you think about the big catalysts of entry into the number one entry into the to the follow on in Canada, demonstrating the capability. Okay, and so that's our major investor highlights. And then in terms of contacting us, so Kin Communications run our IR. Carson Seaton, who's our director of corporate development, is on the is on the call as well, and we're as I said, TSXV, our ticker is ROOF. And we have the Scooby Doo ticker and the OTC, and we had to add an extra O for that. So it's ROOF on the OTCB. Okay, I'll have to. Sorry, I need to lean in to read my questions here. So the first question is good. So in carbon credit revenue, will there be a split of the revenue between Northstar and the provider of the shingles? So like ICO and Calgary. So there it's likely that we will have some degree of split of the benefits with the purchaser of the asphalt. So when the carbon credits get allocated, we have to allocate them some to the aggregate, we'll allocate some to the fiber, and then we'll allocate some to asphalt depending on the energy balance of the plant. Already with the McAsphalt offtake agreement, we've agreed that we'll do an overall benefits calculation of the carbon credit, both from our perspective on the plant versus the base case, and also their perspective, and then we'll share the value in that. That will likely not be a carbon credit that we need to sell externally, but a carbon credit that McAsphalt will take and pay us the value for it. Now, the good thing about the McAsphalt agreement is that has both our benefit and their benefit. So their benefit on how the carbon footprint of their process is helped by ours too. So yes, that's a great question, and each course offtake agreement is slightly different and a slightly different split. Etc. But that's the value realization mechanism. And just in terms of management of expectancy, we need to get the plant online, and then we need to establish the protocol. Once the protocol gets established and the measurement gets done, that's probably 18 months away from the Calgary facility operating. So kind of middle of 2026, I think would be my view there. Yep. So where are we in terms of construction in Calgary? So the Calgary construction is being done with respect on skids. The long lead items have been ordered. So that's the kind of the separator at the front end, the evaporator at the back end, and obviously electrical, substations, etc., which are all long lead items. Those were ordered. And when they're this fabrication work, detailed design likely to be finished in the next month here, and then everything out for fabrication throughout the next few months. With I expect to have stuff arriving in site on kind of middle of the summer, and then, as I say, kind of commissioning in Q4. So good question. It's actually a really good question about where are who are your competitors in terms of securing the feedstock. So one of the things that's interesting about feedstock is actually our competitors are also our suppliers. So if you look at Toronto is a really good example. If you look at that and you look at the big collectors of feedstock, that's the kind of the York ones, the GFLs, the Miller Wastes of Waste Connections, Waste Management of the world, but they're also the potential suppliers to our facilities. So what we have to do in all of these discussions is persuade the collectors, whether that's a municipality or an industrial or a major waste provider, to divert to us rather than bring it into the municipality system. Has there been any back and forth with the Canadian Patent Office? I mean, the patent processes, as you know, is just a kind of is ongoing, and so there's been discussion. There was very little discussion with the US Patent Office. They basically asked us to split the process into three, which we did, and then we resubmitted the first one, and it got approved without almost any modification at all. And so the discussion has been going on with the Canadian Patent Office about the whole process, splitting it into three, etc. But yeah, that's been it. And so the ICO, that's a good question. Do I have an estimate of the percentage of the Calgary capacity that will be taken by the ICO? Approximately, our view is that of 40,000 tons a year, the ICO volume would probably be in the 5,000 to 10,000 tons range. So yeah, I mean, I think it'll be kind of up to 25%, and we're working with other providers to infill the rest, but also chat to the municipality. A quick question: are there costs associated with your feedstock supply? No, that's the real benefit of this business model, in that we get paid for the feedstock, and really the only cost is obviously processing. So I think that's our 30 minutes completed, and I'd like to thank everybody for listening. And yeah, I think we're